This is Richard Ramsden. He basically runs this conference. It's been going on for 36 years. I know there's record attendance. And you had that conversation yesterday with Marianne Lake, the CEO of Consumer Community Banking, which saw JPMorgan stock drop as a result of the surprising guidance she gave on expenses. She, of course, said the biggest drivers were kind of growth related. Activity levels were higher. They were making strategic investments. What signal was the market sending here in its response, and what's your takeaway from the conversation?
You know, look, I was a little bit surprised by the market response, but I think it just speaks to the fact that it just wasn't expected. You know, most banks wait until January to give an update, and most banks talk about outlook for expenses in context with, what they're expecting on the revenue side. And I think the second thing was just the magnitude of the increase in expenses that they're talking about. I mean, market's expecting close to, let's call it $96 billion of expenses this year. She guided to $105 billion next year. It's a very significant increase. And I think it generated a lot of questions around why are they doing this? Is this offensive because they see an opportunity to grow? Or is this part defense because we are seeing some of their peers starting to lean into growth? And that is, they feel that they need to increase investment spend to defend some of the market-leading market shares that they have.
So what's your take? Because I've heard several people here say that this is one of the most competitive environments they've ever seen in the industry, particularly after the financial crisis. So if you were JPMorgan and if you were one of its competitors, how would you be thinking about expenses vis-a-vis kind of gaining that share in this environment?
There's no question. I mean, the competitive environment is getting more intense, and I think, look, there's a number of factors that's driving that. Wells Fargo was released from the asset cap earlier this year after 6+ years of being in the asset cap. They clearly want to grow. Bank of America had an investor day a month ago, and they talked about a lot of their growth initiatives. Citigroup is also looking to grow across a range of businesses, but both in card and in wealth, which are very important businesses to JPMorgan. So look, there clearly is this increase in terms of competition. Look, having said that, JPMorgan has a fantastic track record of investing in their business to drive growth. And I think part of this is also just a reflection of the fact that there is a lot of optimism around the outlook for the US economy next year. I think that one of the reassuring messages coming out of this confidence is just the resilience of the US economy and the resilience of the US consumer. I think even the banks themselves have been surprised at just how well consumer spending has held up in the fourth quarter in the light of the government shutdown, all the uncertainty around tariffs, higher short-term interest rates. And I think as a result, that is informing their view about what the opportunity set is next year. And I think they do see very good risk-adjusted returns in a number of businesses.
Yeah, and of course, speaking of rates, we do have that rate decision and press conference later this afternoon from the Fed. The market is expecting a cut today. The outlook a bit more uncertain for 2026. Most bank executives have reiterated their net interest income guidance. That's the profitability metric for loan making. What's your expectation for 2026, especially given the opacity of kind of the rate picture from here?
Look, we think that net interest income next year for the large banks is going to grow mid-single digit. And if anything, the banks have reiterated it, but said there could be an upside case next year. And I think the reason is that the banks are seeing a pickup in loan growth, especially on the commercial side. So they are seeing a pickup in terms of corporate loan demand. And I think the second thing is, look, increased consumer spend is leading to increased consumer lend. The other thing I think that's driving it is the banks are going to benefit from deregulation from a capital standpoint. There's a lot of excess capital in the banking industry today. That is probably going to grow next year as a result of deregulation. And I do think the banks are now at the margin looking at areas where perhaps they've been a little bit more risk averse from a lending standpoint and looking at whether or not there's an opportunity. I mean, one of the areas that has come up is commercial real estate lending, with a lot of banks saying, look, this has been shrinking for the last 2 or 3 years. We are now starting to see it plateau. But we are expecting that commercial real estate loan growth could actually grow next year. So I think the loan growth picture, I think, is actually pretty good. And also keep in mind, look, lower short-term interest rates does allow banks to reprice down expensive deposits, which is also going to help.
Yeah.
So I think, look, from a net interest income perspective, which is obviously a really important driver to top line revenue growth for these banks, the banks at the margin, I think, are feeling better about that metric.
Yeah, it's certainly a good setup heading into 2026. We appreciate all of your perspective, the great work you're doing here at the conference. Thank you very much, Richard.
It's great to be here.